The Fed's next move. 4 reasons inflation will soar. If you have cash sitting in a savings account right now, you need to hear this, because the next Federal Reserve decision could be a wake-up call. We are now days away from the highly anticipated FOMC meeting, and while the headlines scream disinflation, the underlying data tells a different, far more urgent story. The consensus is pricing in a pause, but I believe that's dangerously complacent. We are not out of the inflation woods yet. Today, I'm breaking down 4 specific, data-driven reasons why we are on the cusp of a renewed inflation surge, and more importantly, 4 protective steps you must take right now to shield your bank account. Stick around for reason 4. It is the macroeconomic headwind most people ignore until it's too late. Reason 1. The sticky service sector and the wage price spiral. The first reason the disinflation narrative is fragile is the stubborn strength of the U.S. labor market. Unemployment remains historically low, hovering near half-century lows, and that persistent tightness drives the biggest concern for the Fed: service inflation. Unlike goods, service inflation is primarily dictated by labor costs, and those costs are sticky. When demand for services stays high, companies are forced to continually raise wages to attract and retain talent. This is the classic wage price spiral in action. Higher wages mean higher costs for services, which feeds back into demand for higher wages. The Fed's rate hikes have cooled the housing market, but they have failed to dent the jobs market. Until we see a significant, structural shift in job reports, not just a single month's blip, expect the structural pressure on the price of services to continue to underpin core inflation, forcing the Fed's hand sooner than expected. Your action here, Action 1. Lock in future costs. Given the inevitability of rising labor-driven service costs, especially for home maintenance, healthcare, or education, lock in any necessary large service contracts now or prepay when possible, before companies adjust their price models to cover these rising payroll expenses. Reason 2. Geopolitical risk and the commodity head. Next, let's look beyond U.S. borders at the global stage. Geopolitical instability is turning commodities, specifically oil and natural gas, into a massive wildcard, a factor completely outside the Fed's direct control. Energy costs are the base layer for everything in the global supply chain, from manufacturing inputs to shipping costs. While oil has traded in a range recently, the key risks are clear: escalating conflict in oil-producing regions and, crucially, the depleted state of the U.S. Strategic Petroleum Reserve, SPR. The SPR is near multi-decade lows, severely limiting the government's ability to flood the market and stabilize prices in the event of a severe supply shock. Furthermore, a weakening U.S. dollar, which is possible if the Fed pivots too soon, makes dollar-denominated commodities like oil instantly more expensive for international buyers, further bidding up prices globally. This environment creates a classic inflationary headwind. Your action here, Action 2. Diversify into real assets. If you haven't, ensure your portfolio has a small, strategic allocation to hard, tangible assets or commodity-linked ETFs. This isn't about speculative trading. It's a vital insurance policy, a classic hedge against the global energy and resource inflation that is ready to strike. Reason 3. The persistent fiscal drag and liquidity injection. Our third reason for the inflation surge is a macro factor stemming directly from Washington: persistent government deficit spending. The U.S. government is running massive, ongoing deficits, funded by issuing more debt. While the Fed tightens monetary policy by raising rates and shrinking its balance sheet, the Treasury is simultaneously executing an expansionary fiscal policy. Think of it as hitting the brakes and the accelerator at the same time. Every dollar injected into the economy through government stimulus, infrastructure spending, or tax credits represents fresh liquidity and fresh demand, fundamentally offsetting the restrictive impact of the Fed's rate hikes. This injection of cash keeps the structural demand side elevated, preventing a significant demand destruction event that would be necessary to truly bring inflation back down to the 2% target. This friction between monetary and fiscal policy is a powerful and often overlooked inflationary catalyst. Your action here, Action 3, protect your purchasing power with yield. Given the certainty of continued deficit spending, your money needs to work harder than ever. You must demand maximum yield on your safe capital. If you're holding cash, ensure it's in a high-yield savings account or short-term T-bills to capture the current elevated rates. The goal is to aggressively narrow the gap between your cash returns and the actual inflation rate. Reason 4. The housing market's mathematical lag, OER. Finally, the fourth and most critical factor is the long, unavoidable lag built into the official inflation calculation itself, specifically concerning housing. The single largest component of the Consumer Price Index, CPI, is owner's equivalent rent, OER, which measures what homeowners would be paying to rent their own homes. The problem is that the OER metric uses backward-looking data and is incredibly slow to reflect real-time changes in the rental or housing market. Even though new leases are slowing, OER will continue to show rising inflation for the next 12 to 18 months because it's still incorporating the massive rent increases from 2023. This mathematical factor ensures that core inflation remains sticky and elevated, regardless of what happens next week. This predictable stickiness means the Fed cannot claim victory and pivot prematurely. Your action here, Action 4, the most critical, maximize your tax-advantaged growth. If your cash is losing value to inflation, you must put it where it can compound and grow shielded from future tax liabilities. Maximize contributions to your 401(k), Roth IRA, or HSA. Every dollar sheltered from future taxes is a dollar that not only beats inflation today, but dramatically increases your long-term post-tax purchasing power. Summary and CTA. So, the four major risks to your money are the sticky labor market, global commodity shocks, persistent fiscal drag from government deficits, and the technical lag of housing inflation, OER. Your four protective actions: lock in costs now, diversify to real assets, aggressively capture yield on cash, and max out those tax-advantaged growth accounts. If you want a deep dive into exactly which commodity-linked ETFs to buy to diversify against oil volatility, click the video linked on the screen now. Don't let your cash melt away. Subscribe for more actionable, professional finance strategy every Monday and Saturday.